Investment markets have borne fruit for investors through the first half of 2023. But what type of branch has the fruit been budding from? Whether stock markets are moving higher or lower, it's critical to understand what the driving force has been. When you boil it down to its simplest form, markets either move higher because investors are willing to pay more for stocks, in turn pushing prices higher, or companies are growing their profits quarter to quarter, therefore the company or companies are fundamentally worth more, pushing stock prices higher. In the first half of 2023, the driving force has actually been the former. Corporate profits, or as we like to call it, earnings momentum, has been negative for both the first and second quarter of 2023. This means company profits are shrinking relative to 1 year ago, yet their stock prices are trending higher. Now, don't get us wrong, as asset managers, we certainly don't mind this type of market behavior. In a way, it means the bottom of the batting order is hitting doubles and triples when normally they actually strike out. Or the penalty killing line is scoring goals when usually they're focused on keeping the puck out of the net. We'd be silly not to be pleased with this type of outcome, nor should you as an investor. However, we are more comfortable as an asset manager when growth in corporate profits are propelling equity prices higher. Because let's face it, we shouldn't expect the bottom of the batting order or the penalty killing line to keep punching above their weight class forever. Okay, so what's the bottom line? As we sit here today, halfway through the year, we're pleased with how markets have performed in the first 6 months. But in the absence of quarterly earnings momentum, our focus will be more on protecting our year-to-date gains. If you tune into your favorite investment market news outlet, whether that be BNN or CNBC, you may very well hear some rather positive commentary about markets. This is in fact very common psychological investor behavior. When the going's good, how could it not keep going well? When the going's rough, how could it possibly turn around? As an asset manager, our disciplined investment process, which focuses on fundamental data, allows us to remove emotion and psychology from the equation. Said differently, until that branch that's budding investment fruit for investors grows a little sturdier, we will remain more focused on protection than on growth. Now, before we provide an update on Matco's investment platform, we did want to touch on a very topical conversation. GIC investment rates have become increasingly more attractive over the last 12 months. Like most investment solutions, they can serve a purpose. However, the limitations of GICs are worth considering. Now, first off, GICs have a fixed rate term. This means that the investor must hold the GIC for a specified period. Although they can be sold, more often the rate of return is materially reduced, or the investor must forego the return altogether when sold. This ultimately lends to a lack of liquidity in the GIC world if you do want that return that you originally promised. Now, secondly, although rates may periodically become more attractive, GICs over the long term have in fact significantly underperformed both equity markets as well as a balanced portfolio. In fact, a laddered GIC investment portfolio since 2005 would have grown from approximately 100,000 to 125,000. Over that same time frame, Matco's balanced fund has grown to approximately 184,000. When compared to a growth portfolio or an investment in broader stock markets, this return gap grows even further. Now, keep in mind, these comparisons include the Great Financial Recession, the COVID-19 pandemic, as well as the market correction experienced last year in 2022. Even with these challenging market periods, the safety of GICs comes along with a significant opportunity cost for investors who may leave a significant amount of wealth creation on the table. So, as always, maintaining a long-term investment focus allows investors to ultimately make more prudent investment decisions. Matco's Balanced Fund is a multi-asset class portfolio with an exposure to fixed income, Canadian, and global equities. The oversight of the fund's investment mix is actively managed by our Asset Mix Committee. Our primary risk tool, which is the Investment Horizon Indicator, increased from the neutral zone and moved closer to the Protect zone in January. Approaching the Protect zone indicates from a risk management perspective, the fund's investment mix should prioritize protection of capital. As a result, the Asset Mix Committee made an active adjustment in the first quarter by decreasing the fund's global equity exposure by 5%, while increasing its fixed income exposure by 5%. In the second quarter, the Asset Mix Committee has held steady with our investment mix. Overall, our January adjustment will offer the fund a greater level of income while providing more protection if the economy does continue to decelerate. The fund is up 3.8% year to date.
Well, the Matco Canadian Equity Income Fund primarily invests in mid to large cap dividend-paying companies and is diversified across many sectors. Year to date, the fund is up 5% and has an annualized 12.8% return over the last 3 years. The fund continues to have a bias towards more income-focused sectors and as a result has a dividend yield of 3.7%, which is higher than the TSX index at 3.2%. Over the last 12 months, 77% of our companies in the fund increased their dividend by an average of roughly 10.6%. During the quarter, we had a number of actions going on in the fund. First, we trimmed our position in ATS Corporation, Quebecor, and CI Financial. We increased our positions in CIBC, Enbridge, Nutrient, TC Energy, and TELUS. And we purchased a new position in natural gas producer Tourmaline. The fund remains underweight energy and material companies relative to the benchmark. The largest sector weights are financials at 29%, industrials at 22%, and energy at 15%.
As a reminder, the Matco Global Equity Fund is constructed of a well-diversified combination of publicly traded stocks. This means that you gain exposure to US, developed international, and emerging markets. Using a growth at a reasonable price investment strategy, the fund's goal is to provide you with long-term capital appreciation. In the second quarter of 2023, concern about the US banks resided, the US market breadth improved, and Japanese equities continued to perform well. Emerging markets, ex-China, also revalued. So in the second quarter, the fund trimmed positions in Novo Nordisk and Microsoft as both stocks rallied and reached a rebalancing threshold. The fund also trimmed its weight in small cap securities globally while adding to Europe and Canadian large cap positions. Over the quarter, Series F returned 3.8%. Year to date, the fund is up 9%. And over the last 3 years, the fund has returned 10.8% annually.
Here's a quick update on the Matco Small Cap Fund. The fund invests in smaller companies that are typically growing faster than the economy. Year to date, the fund is slightly down 2.7%. However, it has an annualized return of 9.4% over the last 3 years. Today, the fund has a high dividend yield of 5.8%. In addition, over the last 12 months, 43% of our companies increased their dividend by an average of 29%. During the quarter, the fund sold its position in Absolute Software on a cash takeover offer. We also sold Canaccord Financial on a failed privatization, and we also sold Leon's Furniture and Constellation Software. We trimmed one position, which was Olympia Financial. In terms of new positions, we purchased a position in Cascades Inc. Now, the fund is well diversified but has a bias towards global growth, with the three largest sector weights being energy at 29%, financials at 18%, and industrials at 12%.
Matco's fixed income fund is a portfolio constructed of Canadian investment-grade bonds with the sole focus of preserving capital while generating income. The fund employs a multi-strategy approach optimizing its interest rate exposure, credit, and yield curve exposures. Given the more attractive yields offered in the marketplace, coupled with the prospect of central banks reaching the end of their interest rate increase cycles, the fund has extended its duration by 0.5 years in the last 6 months. The fund's current duration is 7.7 years, with a current yield in the fund of 3.2% and a yield maturity of 4.3%. The fund will continue to take advantage of higher income levels if interest rates do continue to grind higher. Overall, the fund is well positioned to generate healthy income while also reaping the benefits of capital appreciation if interest rates decrease in 2024, as we anticipate they will.